Okay, it is 12 o'clock and I know everybody's time is valuable, so I'm going to go ahead and get started. My name is Dan Quigley. I am the Senior Vice President of Associations here at Kirkpatrick Management. Thank you all for taking your time to come out today or to get on your computer and eat lunch with us probably and learn a little bit about our association financial analysis. And we're also going to have a part of the program is going to be on accounts receivable. I'm really looking forward to this. We've got our three people who have done this before for us. Joe Holland, who is our financial analyst, Karla Thompson, who is our director of accounting, and TJ Inman, who runs the accounts receivable team. They're all going to be on here. We're going to talk. They're going to give a presentation through here. The presentation is going to last close to an hour, and so we'll have. If there's a little bar at the bottom of your screen, if you look down there, that has a Q&A. If you'd like to put a question down there, we do have a team of the accounting team and is back there. We're going to answer some questions. I'll help answer some questions, and then there will be a question and answer session at the end where we'll be able to ask questions. Kirkpatrick had a very good year last year, thanks to you. We love partnering with the associations. We're getting ready to start our 51st year here in April. And you know, it's a tough year. We had a good year, but it's a difficult year for a lot of you all, and for us as far as we really need good people. We've got some good people, but sometimes good people go other places. So if you, once again, you all got an email a couple months ago from me about we are hiring some community association managers. If something like that comes up, or you've got a friend, a buddy, or you are looking for something a little bit different to do, it's a second career for everyone. It's a neat little business. Nobody really goes to school for property management, but if you know anybody that wants to do that, send them our way. We actually have, at this point now, we have two board presidents, two former board presidents working for us as managers, and 3 other members of their boards are working with us. So it's kind of a neat little deal, and it makes sure that we know what we're doing, and they keep us honest on things. Kirkpatrick Management is still family owned. Still, our headquarters is here on the north side of Indianapolis in the Castleton area. We've got a nice office there. We've also got a brand new office we've opened up since we left you guys last year. I think we've opened up, had a grand opening in Greenwood. So we've got a Greenwood office that's doing very, very well. It's a beautiful place. This is the first of our education series, and we were looking forward to having, we have 4 more of these. We also even have some roundtables for board presidents that you got some information on. Keep that in mind. But, this is we appreciate you taking your time to do this. And if you have to leave early or you don't get the information you're looking for or whatever, we're actually going to send you a link of this tomorrow, along with there's a pamphlet that'll hand out. It's basically ABCs on reading your financial statements. Last but not least, I want to give you guys my phone number. My cell number is 317-847-0016. Let me try that again. It is 317-847-0016. My job is I'm in charge of your people. So if there's a question, not a question, but if you're having trouble getting a hold of the people you need to get a hold of, the manager you can't find, you need an emergency, you need something. Hey, you guys pay for my cell phone. Let's be honest. So this is coming from you. You guys can call me. I prefer you didn't call me at midnight. But if something comes up and you can't get an answer and you got something going on at your building and you can't get an answer from anybody, call me. But we've got this. Appreciate your time. I'm going to turn it over to Karla, and she will get started on the financial statement analysis, her and Joe. But also, if you have a question, there is that question and answer bubbles down there. Put something in there and we'll kind of answer as we go along, and then at the end we'll sum it all up. Karla, you want to go ahead? Thank you.
Sure. All right, welcome everyone. I wanted to just briefly go over our agenda. Okay, just tap that. All right, sorry about that. So our agenda today is understanding the balance sheet, analyzing the budget comparison report. What should you be looking for in your financial report? What happens at calendar or fiscal year end? Savings reserve transfers, and the KMC Connect portal. As Dan said, my name is Karla Thompson. You can always reach out to me, phone or email, or Joe Holland.
Okay, so when you get your financial report from us on a monthly basis, there's a cover page, whatnot, but the first financial report that you will see is your balance sheet. And the balance sheet has three major classifications on it. It will have your assets, your liabilities, and equity. And the balance sheet has a basic formula. It is assets equal liabilities plus equity. So that's why it's called the balance sheet, because those two always balance. We're going to talk in detail about the assets and liabilities and equity, but your equity, it equals your retained earnings plus your net income. But we'll talk about that in a little bit. I have always looked at the balance sheet as a snapshot of what your association owns and owes at the end of a reporting period.
Someone just asked that.
So your most
It'll be
recent
together,
report you'll be getting is your January 31st, 2024. That represents the balances of your assets and your liabilities as of close of business on January 31st, 2024.
Okay. On your balance sheet, you will have all of the cash accounts representative and the actual balance in the account. Now, they could differ from the bank statement for a couple different reasons. Per se, if you have outstanding checks that haven't cleared the bank yet, and also if you have some deposits that say we deposited, they're called deposits in transit. And so we've posted the deposit, but we haven't received the funds, because a lot of times that will happen sometimes with your front steps payments when people are paying online. When you're looking at your bank statement, I just wanted to talk a little about some of the terms that show up on your bank statement. The term lockbox is when people submit their payments via check with their coupon through the lockbox, and that's when they're mailing it in the mail. Image deposit would be when we actually have the payments here in the office and we are posting it to ledgers and we're just depositing here in our office. And then the term FS Pay-HOA, those are the people that are going onto your portal and making your payments via the portal. And then a new term that people may be seeing as of January, maybe saw some in February, it'll say Avid Pay Service, and that is our new payable software that we're using. We've kind of we still do in-house payables, but we are trying to streamline and have the managers approve and pay their invoices through this new service at this time. Also, you're going to have accounts receivable, and that's going to represent the amounts owed to the association by the members. The accounts receivable on the balance sheet agrees to your accounts receivable aging that is included in your monthly report. You will get a separate report that states AR aging, and that shows all the people in the association what they owe, and based on the time that it's owed, if it's 30 days, 60 days, or 90 days out. It will also give the status of the individual account, if they've just gotten a first notice, a second notice, if they're maybe in collections, it will also state that. It's real self-explanatory and easy to read.
There are a few instances out there where some of the associations on their balance sheet have fixed assets. In general, those are very large structures that were built, and instead of expensing those items, they were put on the balance sheet as a fixed asset. I know of maybe 2 or 3 instances out there, and in general, it's going to be like a pool house, fence project, or very, very large pieces of equipment. And the thing I want to stress is when you're looking at what the value is on the balance sheet, it is put on at what the cost was, not the fair market value. So certainly, if something was built 4, 5, 10 years ago, and you see it at this value, you think, oh, it's got to be worth more. It probably is because, you know, all the fair market value has gone up, but it is on the balance sheet at cost, not at fair market value. So we're now down to what the liability section would be of the balance sheet. And it would have accounts payable if you have any unpaid bills at the end of the month. So as of January 31st, 2024, if there was an open bill that was not paid, it's going to show as accounts payable. The other major item that's going to show up in your liability section is prepaid fees, association dues. And I think I want to stress that's not a number you should overlook, because that represents money that is being collected in advance of the due date when it is due. So if you start to see that number going up, when you're starting to project out your cash flow, you do have to remember you are collecting that ahead of the due date. So I think the prepaid fee number is something that you should really keep your eye on and watch the fluctuations in that. But we're going to talk about that a little bit more when we go over cash flow. So we're down to the second section, or the third section on the balance sheet, the retained earnings and net income. There are some questions. People are always curious as to what the retained earnings represents. And it represents the culmination of all your earnings and losses since the formation of the association, since the last fiscal year end. So that number, it does have some value, but it's just a historical number that has built up over time. Your net income is going to be on your budget comparison. You get a section for your operating results and your reserve results. And so those two come down to a net income. And when you add those together, that will equal the net income that's on the balance sheet. So if your operating net income is, say, $10,000 and your reserve net income is $5,000, your retained earnings at that period will be $15,000. And then at the end of the year, your net income is closed out to retained earnings. So in this instance, we had a retained earnings of at 12/31/18 of $100,000 and a net income of $10,000. So now on 1/1/19, you'll see your new retained earnings is $110,000. So you'll be getting your first month statement, your January statement this year. So you'll see, if you were to go back at 12/31/23, you'll see that net income number got rolled into the retained earnings, and your net income at 1/31/24 is for just the net of those two numbers in 2024. Our accounting is on an accrual basis, and I want to stress that. And really, where you see it the most is with the association dues. So when you look at your association dues, that number represents what is billed, not what is collected. So if you're on a quarterly billing, you'll see it accrue, you'll see it come on each quarter. If you're on an annual, you'll see it come on when your annual's due, but it's going to represent what is billed, not what is collected. And the importance of that is because it does tie to the accounts receivable aging. You know, Karla was talking about the receivables. And so for us to be able to track receivables accurately, we've got to make sure we're putting them on as they're billed, not as collected. And this is just a little graph to show you. So the billing department increases AR, so your accounts receivable go up, and your accounts receivable aging is the control document. And as the cash comes in, it decreases accounts receivable.
Your community association managers are now able to pay invoices basically anytime during the month. We used to have 2 payables a month when we were in-house, but going to our new Avid Exchange program, we are able to now pay bills basically whenever the association manager wants to approve them. So it gives them a little bit more freedom and a little bit more time to take care of approving their invoices. We still, however, in-house, for the accounts payable, the payable department, we are paying utility bills, insurance, if there's any mortgage payments, any other bills that may be time sensitive, we are still handling in-house. We do not want those to go through the system and get caught in an approval process. Also, your community association manager is responsible for reviewing for their particular association on Avid Exchange. They first review to make sure they code it properly to the correct GL. It has the correct dollar amount. It's the correct association. And then they're able to go in and they approve it, and then they're able to do another final approval after reviewing and have the payment sent out. Payments now for vendors can either be by check, ACH, or what they call a virtual card, which is all up to the vendor themselves. That is their decision on how they want to get paid. The approved bills, once they're approved, they are posted into the accounting system, so they will be in Caliber. They are now an expense on your budget comparison. So once it gets posted, it will show on your budget comparison, not necessarily when it is paid. My gosh, if the CAM does not approve the bills, they will show up as a open payable, and you do get that report in your monthly financial. And if there's nothing, then it's a blank report. But if you have bills that the CAM for some reason did not pay, they will show up, and then it will also show up on your balance sheet at month end. So basically, the vendor bills come in, they produce a accounts payable aging report, and then they are paid. On your budget comparison, basically, it's going to report your association's income expenses for both your operating and your reserve account. So you have 2 separate budget comparisons. It will compare your actual monthly and annual income and your expenses to their respective budgeted amounts. Your variance column is going to report the difference between what you actually budgeted on both a monthly and an annual basis.
Just remember that the budget comparison report, it records your income when it's the income, when the coupons are sent, and bills are posted when the expenses are recorded, when the bills are posted. So it's not based upon when cash is paid out or cash is received. It's based upon when bills are posted and the dues are recorded. The budget comparison does show the net difference between your income and expenses for both your reserve and operating accounts. So they're broken out in individual reports, and those 2 numbers added together agree to the net income number that's on the balance sheet. So what should you be looking for on the balance sheet? You need to compare your balances to the prior month and ask yourself if you see cash go way down, but you didn't think that you spent that much, or you've got to ask, why did it go down? Why did it go up? Why did receivables go up? Why did receivables come down? But look for those big swings in those numbers and try to figure out what's going on your balance sheet and what's causing it and how ultimately it could be affecting your cash flow. So let's talk about cash flow. From time to time, we have board members or treasurers say, boy, I don't understand why my cash went down so much or went up. And I thought we were just kind of going along on a constant basis. And so, like I said, what you need to do is start looking for those things that can increase your cash or decrease your cash. So if you see your receivables come way down, that's going to increase your cash because you now have collected past due money. Of course, if you don't pay your bills on time and your accounts payable go up, that could cause your cash to go up. And if people start paying in advance or you have prepaids, that could cause your cash to go up. But you always have to remember, if those prepaids are going up, like I said earlier, that really applies to future periods. So you really need to watch how that cash is used. And then, of course, the things that can decrease cash, if people aren't paying in time, your cash could start to go down. If you have a lot of accounts payable that got built up and you do pay those will decrease your cash. And certainly if you start to see your prepaids go down, that's going to be a decrease in cash. This slide's in there. It is a cash flow calculation template. I'm not going to go over it, but it does go through what we just talked about with the increases in accounts receivable, decreases in payable. But you can start with your beginning balance and work down to what your ending cash balance is by going through this calculation. If you have any questions on this, please feel free to call. I love going over how cash flow changes and what causes the changes in cash flow. And so if you do work through this one time, say on your January report, and you can't get it to work out, send me an email. I'll be happy to go through and work through it for you. And I think if you got used to looking, you could really start to see what is affecting the increases and decreases in your cash.
What should you be looking for? So when reviewing your accounts receivable aging, is your aging going up over time? This definitely, like Joe stated, could be a reason as to why your cash flow is tight, is because the dues just are not being collected. Are you turning over past due accounts for complicated legal situations? Staying updated on the statuses. On a monthly basis, the accounts receivable team does give the community association manager an update of where things are standing with attorneys. And hopefully they're reviewing that with you just so you know where all the accounts, if you have some in legal situations, like where they do stand. The next thing would be to make sure that your late fees are being charged per your delinquency policy. So that, you're collecting late fees on people that are not paying on time so that it can, just make sure you're getting it collected. You can review your DPR over time with your manager, or I know TJ is going to talk about that as well. On your check register, it's not a bad idea to review where the bills were coded to what general ledger. You know, when you work on your budget with your manager, it's always a good thing that you're on the same page of, you know, where are you posting your lawn care, your pool, just general maintenance, so that they can make sure that they are coding everything appropriately. Some people, you know, could have a different interpretation. And, you know, anytime during the year, you can review that, especially if you're noticing a variance on your budget comparison, to make sure things are posted properly. I know you can view all of your invoices on the portal. So that way too, you can look to see maybe, oh, that shouldn't have been coded there. It should be, you know, coded somewhere else. And your manager can always get that in contact with one of us in accounting, and we will definitely get that coded correctly for you. You know, the check register is just a good tool to look at, and you can, you know, gives you a snapshot of everything that you paid for the month. Another thing on reviewing your budget comparison report, like I talked about, just making sure, are your expenses, do you have a real high variance in something and nothing in another category that you had budgeted, that, you know, maybe it should have gone to grounds, it should have gone to landscape contracts. Any of those things definitely are worth looking at on your budget comparison to see if you have any really large swings of positive or negative variances.
So once again, on what you should be looking for, you know, being on the board of an association it's a big job, and you have a lot to keep track of. But I think it's very important that you always look to the future. Too many times we see where things come up and the association is just not prepared for these future events that come up. So, you know, always keep in mind, there's so much that goes on with the day-to-day on being on a HOA or association board, but keep in mind there's this entity that needs to move forward into the future. And so you have to plan through that and be ready for things that can come up. Certainly financially, that's very important. And finding knowledgeable partners, hopefully, you know, KMC is one of those, your attorneys, accounting, insurance, but all of those people that can help you do your job better. And, you know, budget accurately and honestly. Certainly in today's world, you know, prices are going up everywhere, and your association's being affected by that. And whether it's through increased lawn care, insurance, all those things are going up. And, you know, it's hard to go out to the community and say, we've got to raise dues to keep up with that. But you've got to make sure and budget accurately and honestly. And, you know, it does have obviously an effect on the people that live there, but it's just everything is going up right now. And certainly, you know, if you do that, hopefully then it can avoid any special assessments that would come up and really have, you know, a financial impact on the people that live there. So at calendar end, the accounting department prepares the financial report based upon the bills that were entered. And so you may have a timing difference at calendar end where you do have a payable that's open and it's not been paid, but that expense will still show on the previous year. Likewise, from time to time, you know, bills stagger in. I know on some associations, we're still getting a few bills from December. And so, you know, those bills are going to be posted into this fiscal year. They're not going to go back into next fiscal year. Now, from time to time, there could be a large bill that could come up. And you had budgeted and planned for that, say in 2023. Certainly, if you ask, we can move that bill back so it reflects into the budget period that you want it to. But typically, those would only be done on larger bills. Now, if your association is receiving a CPA audit, the auditor is required to take all the bills where work was performed, say in calendar year 2023, to move all those back into the fiscal year that they would apply to.
So what is all required for reserve transfers? Anytime that association is going to move funds from the reserve account to their operating to pay an invoice, the community association manager is responsible for getting the reserve transfer request signed by the regional manager, the board president, and an accounting manager. Usually they send this through the DocuSign, and they have to have all of their backup. They have to have invoices. They have to have any documentation, meeting notes, anything that, you know, is stating on the approval of this, as well as the vendor has to have proof of insurance and a W-9. And then once that's all completed, the accounting department will receive it, and then we will turn around and get the invoice paid. That is not something we run through our new Avid Exchange program. And these are all done in-house, since they're usually time sensitive and they require more signatures and backup. And then last, we'd like to talk a little bit about your KMC Connect portal. Everyone can sign into it. There is a different version that you can, you know, as being a board member, you can see a few more things that the just homeowner cannot. You're able to update your homeowner information. You can always log on and see the status of your account. You can pay your HOA dues there. You can check for compliance violations if you are a board member. You can put in maintenance requests. You can access a homeowners association documents that would be also board only to view the invoices. And then also you can see your delinquencies as well if you were on the board. You can easily sign up for it if you haven't already, and you can go to our website and follow the prompts, or anyone in the office. I know all of our CSR staff is available to assist anyone in getting signed in. And I want to thank you all for joining us.
Okay, we're going to go ahead and thank you for, we do have some questions that we're going to ask Joe and Karla at the end. I'm going to go ahead and turn it over to TJ. TJ is actually going to run through accounts receivable and some normal questions that he might have. Once again, you can put your questions in the question and answer sheet. There's a couple of them that we're going to have Joe and Karla take a look at now so they can answer. I did like the suggestion of next time having a split screen, just so we can kind of, you can see what we're talking about. But I don't, I think this might be the first time we've presented it and it wasn't live. So I think that that's probably our in person. Last time we did it was we had hundreds of people stacked in our warehouse, and we can't do that anymore. So what's a good suggestion. We'll try to do that next time. But and we will be sending a sample financial statement along with the booklet we're sending out tomorrow. So you should be able to follow through very quickly on that. TJ, I'm going to go ahead and let you go. Thank you.
Thank you, Dan. Thank you, Karla and Joe. My name is TJ. I'm the accounts receivable manager for Kirkpatrick. Thank you, everybody, for taking your time today. We'll get to the questions at the end. And just a quick FYI, please no questions about a specific name of an account that's in delinquency. That's not something we can discuss in a public setting. Any generic questions about delinquencies, obviously we'd be happy to discuss those, and any specifics, for a particular homeowner, please, contact your manager or our accounting department. We'd be happy to talk about those in a non-public setting. So accounts receivable, as Karla and Joe said, that's the measure that the homeowners owe to the association for the services that the association provides. KMC's AR team, myself, Colton West, and Vicky Diggs, we do our best to follow industry standards and best practices to minimize the debt owed by homeowners, maximize the cash flow the association has available. Of course, there's always going to be times when owners do not pay, and collections agencies are needed to help collect the outstanding debt. So some of the things I'm going to talk about today is ways to make sure that the HOA's interests are protected and that the liabilities to the HOA throughout that collections process are minimized. So Karla and Joe mentioned this, the DPR, or delinquency policy resolution or process resolution. It's a very important document that standardizes exactly what your community is going to do during the collections process. So once the dues amount is determined by the board and by the budget, of course, that gets turned into my department. We create payment invoices that go out to those homeowners. Ideal world, every homeowner gets the invoice and pays the dues right when they get the invoice. Everything's on time, no problems at all. We don't live in an ideal world. So some people are not going to pay. It's critical to have a standard policy in place to handle those accounts that do not pay. That's where the DPR comes in. Okay. Now, Kirkpatrick, this was about in 2018, 2019. We consulted with Eads, Murray, and Pugh. Some of your communities do use EMP as their collections firm. It's one of the ones that we use most often to help us create a standard template that they felt would protect the HOA in the event that an unpaid debt had to go to small claims court. That was very important for us to find a document that we could use across all of our communities with minor tweaks here and there to customize it to each community that would protect the HOA in those small claims cases. This is a just our standard DPR template. If your community does not have one, if you're not sure if you have one, please ask your property manager for a copy of your DPR, or just ask them, hey, can you check and see if we have a signed DPR? We do our best in AR. The collections firm does their best to make sure that we've got one on file. But if you're not sure, ask the property manager if you have one. We'll take a look for you and make sure you do have it in place. So it's the standard one here. I'm going to point out kind of the key things, and you'll notice this document is generic on purpose. It's vague on purpose. We do not want to have specific things in here like a timeline that lays out first notice will be sent on exactly February 1st. Second notice will go out 30 days later. Final notice will go out 30 days later. We don't want to put that language in there. We're going to follow a process, but we don't want to put the language in there that's going to spell out exactly what is going to happen. The reason being that we were noticing and Eads, Murray, and Pugh was noticing in some collection cases, the policy would say that a notice would go out after exactly after 30 days. We sent out a notice after 32 days because the 30th day was on a Saturday. We don't send out notices on a Saturday because we're not in the office. So we sent it out on the Monday, 32 days. An owner took that to court and said, look, they didn't follow the policy. It says exactly 30 days. They sent it out 32 days later. That's nitpicky, and it did not hurt the owner at all. It gave them 2 extra days. But a small claims judge would be inclined to possibly, not likely, but possibly punish the HOA for not following the policy exactly as it was spelled out. HOA would then be liable to pay those attorney fees instead of the owner being liable to have that added on to their debt that they owed the association. So we want to make this document vague and then have the policy that we follow internally as specific as possible. But the one that's available for the homeowners, available for the court, we want to make sure that that's vague. Now, we do want to point out that in this policy, the association does have the right to charge late fees. They do have the right to turn the matter over to the attorney for collections. Okay, the association does have that right if the owner does not live up to their contractual obligation to pay the debt. So the delinquency policy starts with that invoice that the owner gets, and that gives them the due date and then the late date. Every community is going to be a little bit different, and we are able to customize our delinquency process for your community however you want it. If you want your dues due on the 1st, late on the 5th, we can do that. Due on the 1st, late on the 30th, we can do that. But once we have that policy in place, we don't want to change it until that next billing cycle. We do not want to communicate something to the homeowners that tells them, hey, your dues are due on the 1st, late on the 30th, and then in the middle of that cycle or that fiscal year, before any additional invoices go out, the board decides, actually, we want dues to be late on the 15th. 30 days is too long. If we wanted to change that late date, the board decides, hey, we want it on the 15th instead. That's something, a conversation that we would have prior to the next invoices going out. And then we would enact that new policy at that time. But we don't want to do it in the middle of the billing cycle. Now, our notices, I'll show you an example of those. The most common policy that we have is 3 notices go out. There's the late date. First notice goes out right after the late date, gives the owner 30 days to pay. We send a second notice 30 days later. And then after that second notice, they get 30 days. And the final gives them 10 days. I'll show you the difference between the first, second, and final notices. Here's the template for the first and second notice. It's the exact same template for both of them. We do our best to keep this as non-threatening as possible. We do not want to go to your neighbors with any negative language if we can avoid it. So this is a friendly reminder that the account's past due. We give them the balance, tell them the instructions for mailing their payment, requesting more information, contact our office to get a pay plan. And then we put at the bottom, if they've recently made the payment, please disregard the notice. You know, it's very possible that the payment was mailed out and is en route to our office when we send out this notice. So they get the notice after their payment's already been cashed. We're trying to let them know that's a possibility, and if you know you've paid it, please disregard. Of course, there's always going to be people that want to call in and check and make sure. That's perfectly fine. The contact information for the accounting department is included on the notice. Now, the final notice, a little bit different, right? There's the boldface type there, final notice. Try to get some attention there before we have to move further in the process. So we find that your account is delinquent in the amount of, given the balance. Let them know the association has the right to seek legal remedies against any owner whose account is in arrears. Okay, giving them 10 days. So this notice, unlike the first and second notice, this gives them a timeline, right? Gives them 10 days from the date of the letter to pay the balance. If they don't comply, it might result in legal action. And if legal action gets taken, those costs are the responsibility of the owner. Again, they still have the option to contact our office, hopefully make a pay plan, discuss the problem with the account. If they believe they've already paid it, contact us. We can look into it before it moves further. They've still got that option at this point. Okay. So we'll get into what happens if they don't. Karla and Joe mentioned the AR aging report. This is just a generic look of what that is. This is available to you on the KMC Connect dashboard for board members. So you're going to see the account number, the person's name. Obviously, your association would be up here at the top. And then this would be just a listing of through that day. So you want to make sure you select that day as the day that you're running that report from, because you don't want out-of-date information. So you're looking at the total balance, and it breaks it down by what is actually owed by oldest unpaid charge first. And then the status column is the other one that's important. That shows where this account is in the collections process. It could be at first notice, it could be at second notice, final notice, or collections approval, which means this account has gotten all of the notices sent to it. The 10 days on the final notice has passed, and the account is now eligible to be sent for collections. So that process, once an account expires on that final notice, so 10 days has passed from when that final notice went out, the owner did not contact us for a pay plan, the owner did not pay the balance. Once that happens, the AR team sends an email to the property manager, lets them know, here are the accounts eligible for collections for this community. That email should then be forwarded on to the board for the board to make a decision on what they want to do with that account. Kirkpatrick Management is not going to send accounts to collections unless told to do so by the board. This is your community. It is your decision to make. We are here to help you act that along. We are here to enact your wishes on that. So we follow the policy. You get the information. Policy's been followed. Accounts ready for collections, and you get to make that choice. Now, the way that we kind of want to make sure you understand is it should not be a choice that you have to make from one account to the next. It should be a consistent policy. We know that we set this policy forward. All the notices went to this owner. They did not pay. So green light to go to collections. But ultimately, we want the board to let us know, yes, we want to move forward with collections for these accounts. But you need to be consistent with that, something I'll touch on before I'm done. So, like I just said, if that 10-day period passes, you get that email, the board chooses what they want to do moving forward. Couple of different options. We can send another final notice, give the owner another 10 days to pay. We can proceed with collections. We can wait and do nothing. We can let the account sit there in approval until that next billing cycle, and we can start the notice process over. Maybe the balance is like $100, and you don't want to send that account to collections for just $100. So we send more notices, give them a chance to clean that balance up before it builds up, but not send it to collections. Those are options. Okay, and if you have questions about what we think is best, we'd be happy to share kind of our experience and our opinion with you if the board has questions at any time. Okay, contact accounting, contact the property manager, and we can go over, hey, in this instance, we think this would make sense. So what happens if all those things occur, the board chooses to proceed with collections? What does that look like? The first thing that occurs is Kirkpatrick Management adds a $75 management fee to the account ledger. We then send that ledger plus copies of the notices that we sent to the owner to the collections attorney that the association has chosen to use. The HOA will pay that $75 management fee to KMC, and whenever that owner's debt gets collected, the owner is reimbursing the HOA. Okay, the collections attorney is going to first verify the ownership information. They're going to verify the mailing address, make sure that Kirkpatrick Management sent those notices where they were supposed to go according to the deed for that property. And then they send a demand letter to the owner. That demand letter gives the owner 45 days to pay, dispute the debt, or enter into a pay plan with the association's attorney. So the owner has options at this point for how they are going to proceed, and they've got 45 days to do that. If those 45 days passes and none of those things have occurred, the collections attorney sends an affidavit of debt to the AR department. We fill that out, make sure the information is correct, get it back to the collections attorney, and they file in court and await a hearing date. Okay. So the owner at this point can still pay, can still enter into a pay plan up until the day of the hearing date. Now, the further this goes in the process, the higher the cost is rising for the homeowner because of work that the attorney is doing and things that they are filing in the court. So, if a hearing occurs and the HOA gets a judgment, the owner then has 30 days to pay that judgment. Now, in these court hearings, the association is required to have a witness in most cases. The witness comes from KMC. So we take care of that for you if the board, for whatever reason, would like to have a representative from the board there as well, or they want the property manager to go. Those are discussions that can be had, but it's not necessary. We send a member of our AR team to those court hearings to act as the HOA's witness, and that's part of that $75 management fee. So the owner then has 30 days to pay the judgment. Failure to do so results in the collections attorney attempting to file the garnished wages. HOAs can take up to 25% of an owner's take-home pay that can be garnished until that judgment gets paid off. Now, there's some variables with that. Some owners are judgment-proof because they're privately employed or they're elderly and no longer work. You cannot garnish Social Security wages. So in those instances, there are other avenues that have to be taken. If a balance is particularly high, there are other avenues that have to be taken. Small claims court is not the only tool that the HOA has at their disposal. Okay, in order to enforce the payment of dues, the HOA can also choose to file a lien to ensure payment. Lien costs are typically around $225. That's a ballpark figure. And if you ever have questions about the cost of legal services, we can get you cost sheets that show, hey, we're thinking about filing a lien. What exactly would that entail? We can go over with that in those specific situations. But on average, you're looking at about $225 both to file that lien and have it eventually released. So once filed, that lien ensures that if the owner attempts to sell the property at any point, the HOA is paid in full. Okay. So the title company would do a search on the title. They would pop up that HOA lien for unpaid assessments. And in order for that sale to move forward, that lien has to be paid off. Now, a lien also opens the door for the lien foreclosure. Okay, foreclosure is a scary word. That's a scary process. It's very serious. Condos can foreclose on liens immediately, while HOAs have to wait 90 days before foreclosing. So 90 days from the date of the lien, the HOA can foreclose. Condos can foreclose right after they file the lien. That process, again, it's a serious one. It's a last resort. A lot of people are not aware that not paying your HOA dues could result in the loss of your home. It's just like a mortgage. If you don't pay the mortgage, eventually the bank can take the property back, and the HOA can do the same thing. So it's usually not advised until the account balance exceeds $2,000. Again, there's variables there because monthly communities are going to be different than quarterlies, different than annuals. So it's going to be different, but in general, you're looking at a $2,000 barrier to think about starting that process. Lots of different charges involved there. You've got title reports, court filing fees, the sheriff's fee, the attorney's post-judgment work. you're looking at $2,500 to $3,000 on average, and it's a process that usually takes 6 to 9 months to go from beginning to completion. So it sounds like a nightmare, right? Why would an HOA ever attempt to foreclose if that's the process? It's a good question, and it's one that it's only used as a last resort. As you can imagine, it can be quite effective. If an owner has not taken it seriously before, if they get an intent to foreclose letter, you would think at that point they're going to take it seriously. So if they are capable of paying, that's going to be the trigger that gets them to do it. Now, some people, they just don't have it. They do not have the funds. They did take it seriously. They applied for assistance. They didn't get it. And now you're foreclosing and they don't have a way to pay. In that case, or if the owner is just ignoring it and that intent to foreclose letter fails, if the process goes through to completion, at the very least, you've got a new owner, ideally one that pays the dues, that'll go into that property, right? So you're cutting your losses. This owner hasn't paid, let's say you're a monthly community, owner hasn't paid you for 9 months. At the very least, you cut your losses there and you get a new owner in that will hopefully pay each month, and it's no longer that sunk cost for the HOA or for the condo association. It's also possible that the proceeds from the sheriff's sale will pay for the delinquent owner's debt. The mortgage has to get paid off first. So if there's an unpaid mortgage, that's always first in line. If that gets paid off and there's still excess proceeds, which is very possible, the HOA gets second. So the association could recoup all of the debt that the owner owes, and whoever purchased the property is now the owner of the property and hopefully one that pays. So it's a process that you only want to use in a last resort, but it is an effective tool if needed. The important reminders: you want to have that documented, established collections policy. Check with your property manager to make sure you have one. And if you don't, we can help get one in place. Second, be consistent. It is a huge deal not to treat different owners differently. Okay. If an owner has a $500 balance, contacts you for a 3-month pay plan, and you deny it because, oh, I know that guy, I don't like him. Another owner contacts you, has a $500 balance, asks for a 3-month pay plan. Oh, sure, yeah, let's give it to her. She's great. You can't do it that way. You have to treat owners the same, have a consistent policy. Doing anything different than that and making judgment calls on who deserves a pay plan, who deserves to have a late fee waived, that gets you into trouble. Okay, the HOA cannot make a homeowner pay the dues. The AR department, we cannot make a homeowner pay. However, we do have several tools at our disposal to kind of enforce the dues, okay? And we can use those as necessary. The homeowners have a contractual responsibility to pay their dues on time. It is the HOA's responsibility to collect those fees on a consistent basis for the good of the whole community. That's what our AR department is here to hopefully help you do. Hope you enjoyed that. Again, there's my team in accounts receivable. Justin Kersey does the closings. They'll do a great job. If you need anything, please do let your property manager know or reach out to accounting. We'd be happy to help. And then I was asked to include this, our new customer care program. I'll let Dan talk about that, and then we'll get to questions.
So real quick before we get to questions, customer care program, something we started a couple years ago. It sounds like we're trying to sell you something and we're not. It's basically Kelly Soto. Her job is to just talk with the board members. You guys should be getting mailing emails from her or different things from her throughout the year. Her job is to work with the board directly and make sure, you know, when problems pop up, there's something going on here, there's something they don't understand as far as you know, sometimes we change managers or there's just different questions. That's something that she can answer for you. We'd like to get the problems when they're smaller before they get bigger. She primarily works with the board presidents, so they should be getting information from her, but it's really something that we just try and make sure that we get there's an open line of communication for the presidents. She's also the one who puts on the roundtables for the presidents that we're going to have, presidents of the association. So it's something, if you haven't gotten it yet, you should be getting some emails from her periodically through the year. If you don't, get a hold of me and I'll make sure we get you on the list. And so you can ask questions and see if there's any questions. She can usually take care of those questions. I am going to ask, there's a couple different things we're going to answer live, but before we do that, I do want to say that David Boone from Ashbury Park Homeowners Association did win the $50 gift card. So we will be getting that out to him. Congratulations, David. I appreciate you sitting in with us on this. A couple questions. Joe and Karla, could you discuss a little bit about the importance of reserves for the associations? The reserve studies, possibly, just to kind of keep things rolling.
Well, I think you just hit the critical term there, Dan, and it's reserve study. You know, the reserve study is going to determine, you know, what your reserves need to be now and into the future.
Okay.
And I think it's very difficult for just the board to try to project out what the needs are going to be. And so I think, you know, the reserve study is an important tool to, you know, determine what level of reserves you're going to require. Now, if your association doesn't have that much that it's going to maintain, then you can probably estimate into the future what it's going to need. But it is very, very important to maintain those reserves. You don't want to be caught at a point where you don't have them and need them.
Okay. There was a question about contract liabilities. I thought you touched on that a little bit, but that's newer than if there's any way you can talk a little bit about why we need to show contract liabilities, even though as Roy says, they don't owe any money. So
yeah, I will tell you, if somebody could get either Karla and I an email, I have a whole separate presentation I could get you on contract liabilities. But real quickly, not that many of you are seeing that on your balance sheet. You're only seeing it if you are getting an audit done. And a couple of years ago, the Financial Accounting Standards Board came up with a ruling that dictated on how long-term contracts are being accounted for. Homeowners associations got caught up into that. And really what it's saying is, you know, you're collecting these reserves for into the future, but you're not necessarily spending that money. And so what the Accounting Standards Board said was you need to match your revenue with these long-term expenses. So let's say in year one, in your reserves, you collect $100,000, but don't have any reserve expenses. That entire $100,000 is going to move over into contract liabilities because you don't have any expense to match it up with. But that is only done at the year end by the auditor. So let's say the next year you have $20,000 in reserve expenses, and you once again collect $100,000. $80,000 will move over into contract liabilities. So now your balance in contract liabilities will be $180,000. Your contract liability account should equal then to what's in your reserve accounts. But like I said, I have a whole presentation put together on that. And if you get us an email, we can get that to you. There's a very good example attached to it. And so hopefully that could help you better understand contract liabilities.
Thank you, Joe. And what about there was a question on accumulated depreciation and allowance for bad debt. I guess depreciation expenses on their balance sheet, but not on the income statement until the last month of fiscal year end.
That is going to be another adjustment that the CPA is making, whether you're just getting a tax return or an audit. So we touched upon the fact that you have fixed assets. Well, each year, the accountant depreciates that asset. So let's say you have $100,000 asset and the CPA determines it has a useful life of 5 years. So each year there would be $20,000 in depreciation expense. And each year then your accumulated depreciation would increase by $20,000. We do not make adjustments to the depreciation account or the accumulated depreciation on an interim basis. That would be done by the CPA who maintains the depreciation schedule at year end.
Thank you, Joe. Sean Hamer had a question. Why are there 2 income statements and 1 balance sheet? I guess they wanted to know why there's 2. Do you know that one? I'm missing that one.
Well, there is the operating budget comparison report and the reserve budget comparison report. But the balance sheet is on a combined basis. So it shows your operating account and then it shows your reserve accounts. And your payables could, if you have payables, it could be a payable for reserve expense. But I think the critical thing is the balance sheet has the breakout of your operating account and reserve accounts. So it is somewhat broken out.
Okay. I think that's it. I think we've answered a lot of questions. We actually had over 41 questions come through during the presentation, and we tried to do our best. Had a team of Mark Kirkpatrick, Holton West, and Sarah Nowicki were here getting stuff together to, and they were answering questions the whole time. So I think we got you the answers you need. Make sure that you can, make sure you reach out to us if you've got any questions. I will make sure that the email and phone numbers for Joe and Karla and TJ are on the presentation we send out tomorrow so that you guys can get a hold of them. But we just really appreciate everything you do for us. We enjoy the partnership with you. Your community association manager should be your first round of or should be your first question if you've got questions, because what they do is they work every day in the same office with these guys and they'll walk over and ask them questions. So I think that we will we have more sessions coming up later on this year, and you'll get that in the in your financial packets. But other than that, I appreciate everything. And there's one question from Susan Vaughn. Is there a recession for onboarding of new board members to know what services are available through? I believe we do have one of those coming up. If not, there is one on YouTube, our YouTube channel. And I will we'll send out links to that. So you'll get a lot of information from us tomorrow, maybe too much information, but we'll get it to you. I appreciate Joe, Karla, TJ, Colton, Mark, Sarah, appreciate all your time. And I'll have we'll stop here, but appreciate everybody's time and thank you for coming out today. Have a great evening.
Thank you.